Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market review and sector updates for August 19th. This video presents a direct informational narration of the source document. Section 1. Macro and Treasury Dynamics. Okay, let's just dive right into it. The source document notes that global sovereign debt has been getting hammered lately in a severe sell-off. This massive pressure actually pushed the 30-year U.S. Treasury yield up to a 20-year high. And the wild part? The trends indicate it could just keep climbing. Naturally, this sparked some serious market panic, which practically forced an emergency intervention just to calm things down. So how did they step in? Well, the Treasury dropped a major announcement. They're expanding their long-term nominal bond buyback operation. They're literally doubling it, from a previous maximum of $2 billion to at least $4 billion per operation. And that kicks off on September 9th. Now, you might be thinking, $4 billion? That's not that much in the grand scheme of the bond market. But the signal this sends? It's absolutely huge. By actively stepping in at the long end of the curve, they've set off some wild speculation. Everyone's asking, are we actually shifting toward yield curve control or YCC? You've got to ask yourself, why is there such a crazy lack of liquidity in the Treasury market right now? Honestly, it's a perfect storm. It's not just Federal Reserve policy uncertainty and traders demanding higher risk premiums. Think about the AI boom. This massive wave of corporate debt issuance is actively crowding out treasuries for market capital. And on the flip side, the demand is drying up. The top 3 foreign buyers, Japan, the UK, and China, they all dumped U.S. bonds back in June because they're dealing with their own domestic financial constraints. And hanging over all of this, the U.S. national debt just blew past a staggering $39.9 trillion. And it gets worse when you look at the structural hurdles we're facing. Based on the source document, the U.S. federal deficit for just the first 10 months of fiscal year 2026 has already hit $1.8 trillion. Yeah, trillion with a T. At the same time, the trailing 12-month interest expense has completely ballooned to nearly $1.4 trillion. It's a total vicious cycle, right? Issuing debt drives up the interest expense, which widens the deficit, which means they have to issue even more debt just to fill the gap. With this astronomical volume of debt, jacking up interest rates any further is virtually impossible unless you want to completely destabilize the bond market. Section 2. Currency and Commodities. Let's look at the market reaction. That Treasury buyback announcement we just talked about, it triggered a really sharp response across the board. We saw the 10-year yield get pulled down rapidly from its intraday high of around 4.75%. Adding another layer to this whole macro puzzle, we've got some pretty notable geopolitical updates. According to the source, Donald Trump has kind of shifted his stance, mentioning that negotiations with Iran might actually happen at some point. Plus, anonymous U.S. officials are reporting that a secret channel has been opened in the Strait of Hormuz. Apparently, they're securely moving about 10 million barrels of oil every single day through there, which is roughly half of the pre-war level. This brings us to a really fascinating divergence playing out in the markets. The U.S. dollar index just dropped below 99 for the first time since June. This was driven directly by those declining yields shrinking the interest rate differential, which naturally led to capital flowing out. On the flip side, gold surged above $45. We're seeing macro hedge funds and sovereign capital increasingly park their money in gold. They're viewing it as a critical, hard asset hedge against potential debt monetization, inflation, and just general fiat currency devaluation. It's a classic flight to safety and definitely something to keep an eye on. Section 3. Cryptocurrency market developments. So that dip in yields and the weaker dollar we just mentioned, it actually provided some solid macro relief across risk assets. We saw the NASDAQ get pushed slightly higher, and it really propelled Bitcoin to go up and test that $69,000 resistance level. Over in the corporate crypto space, Coinbase had a really solid day, with shares jumping 9.6%. This spike came right after they announced the integration of the decentralized platform, Hyperliquid. They're doing this to offer crypto perpetuals trading straight on their base app. So, eligible users can now access up to 50x leverage and trade across more than 290 different markets. Now, here's the catch you need to know. This feature actually excludes users in the US, the UK, and Canada. But even with those restrictions, it's targeting an absolutely massive segment. Perpetuals make up roughly 75% of all crypto trading volume right now. Section 4. AI sector competition. Let's switch gears and look at some tech updates. Just a couple of quick technical notes straight from the source here. SpaceX had a bit of an intraday rebound to fill a gap, but it quickly lost steam and fell back. It ended up closing with a short-term bearish trend, dropping below its moving averages. We saw a similar story with the semiconductor index. It just kept up its downward slide, breaking right below its monthly moving average. But check out this crazy financial contrast reported by the Wall Street Journal in the source document. On one hand, you have OpenAI. They brought in $6.7 billion in Q2 revenue, which is a solid 18% bump quarter over quarter. But their operating losses, they completely widened out to a staggering $12.3 billion. Then look at Anthropic. Their Q2 revenue hit $11.6 billion, and they actually pulled off a slight operating profit. It really puts the intense, cutthroat competition in this space right into perspective. And to make things even harder, you've got U.S. enterprise customers increasingly outsourcing their AI tasks to cheaper Chinese models, which is just adding a ton of pricing pressure across the entire industry. Section 5. Semiconductor Industry Updates. Building off that pricing pressure, let's take a look at how the landscape for custom chip manufacturing is shifting among the big tech players. The source details a massive new agreement here. Marvell just signed a custom chip deal with Google, and as part of this, they gave Google a warrant for up to 59 million shares. That's valued at around $12.18 billion. But weirdly enough, despite locking in this huge partnership, Marvell's stock dropped from a $245 open down to $228, closing up less than 10% on the day. On the other side of the fence, Broadcom took a 4.6% hit. Why? Because the market is waking up to the fact that Broadcom is facing some very real competition. Google is aggressively expanding its list of custom silicon partners for its TPU business. They're bringing in Marvell, MediaTek, and AMD into a space that, until now, was pretty much Broadcom's traditional stronghold. Now, to actually sustain this massive AI build-out and fight in this intense competition, you need capital, staggering amounts of it. Take NVIDIA, for example. They just announced a massive $4.5 billion convertible notes issuance. They split this cleanly into two tranches, $2.75 billion due in 2030 and another $1.75 billion due in 2034. The source points out that these funds are specifically earmarked to keep their expansion going. We're talking data center construction, heavy R&D, and of course scooping up as many vital GPUs as they can get their hands on. And then you look at CWIV's debt profile. It is genuinely eye-watering. So they issued $5.0 billion in April, right? Then another $3.5 billion in June. But then they piled on another $30.0 billion in debt during the second quarter alone. Because of that, their Q2 interest expense hit $640 million. And get this, their projected Q3 interest is expected to skyrocket to somewhere between $860 million and $940 million. CWIV is so heavily leveraged right now, it creates this structural reality where they absolutely have to deliver explosive, nonstop revenue growth just to keep the lights on and cover this massive ongoing interest burden. Section 6. Biotech Clinical Developments. Let's step away from tech for a minute and check out the latest trial breakthroughs in biotech. We've got a much more optimistic update here, a major medical milestone, really. Moderna and Merck's experimental mRNA cancer vaccine just yielded some highly positive late-stage data. It actually demonstrated the ability to prevent high-risk melanoma from recurring or spreading. The market loved this incredibly promising news. Moderna shares surged almost 17%, and Merck went up 12.6%. This is a massive, historical turning point for Moderna as they try to build out a really robust oncology business now that their COVID-19 vaccine revenues are naturally fading. You know, this pivotal partnership isn't even new. They've actually been working together since 2016. They zeroed in on melanoma initially because that specific tumor typically has a very high mutation burden, making it a prime target. But they aren't stopping there. Moving forward, the research teams have ongoing clinical trials that are expanding this exact same mRNA treatment approach into lung, kidney, and bladder cancers.